Our next presentation and our final presentation for today is from Paul and Lynn Robertson from Aura Lending Services, Financing Options for Small Business in the New Normal. The hospitality and tourism industry have been hardest hit as far as the bank's willingness to lend money. There's been some help offered by the banks to primarily defer loan repayments to small businesses affected by the pandemic, which has kept many businesses afloat. As this help has now been formally withdrawn, any request for further help for businesses still experiencing hardship will need a new formal application to the bank outlining the reasons and would need a clear exit strategy and timeline. So I introduce Paul Robertson.
Thank you very much. Thanks for the opportunity to be here today and make our presentation. Difficult times, but let's talk briefly about our business. The business owner is my wife, Lynn Robertson. Lynn's ex-Macquarie banker, 17 years with them, and prior to that, St George Bank head office branch manager, and very experienced in both residential and commercial lending. I also have a banking background. I did some time in the purgatory called Macquarie Bank, and prior to that, Commonwealth Bank and State Bank of New South Wales. So between us, probably more years banking experience than we care to remember. We have a home office. We were already working in an environment very similar to what is the environment that's being created by the pandemic. We have clients in England and in Singapore, and had those clients for many years and dealt with them effectively without coming face to face. So the new normal for us is a continuation of the normal that we had developed to effectively run our business. Lynn's with me today, and we also have Sharon and Alana, our admin ladies that look after us. They're here today as well. We're accredited with a multiple of lenders, all the major banks, and a whole raft of second-tier lenders, all who specialise in different tranches of money. There is a lot of money available in the system at the moment, and two clear distinctions between available credit. The credit available for individual consumers for residential lending is quite focused, and the scrutiny is quite savage, in fact. Lenders are even querying discretionary spending these days. We can help you through that, but it is a difficult process for consumer lenders compared to small business sector. There's a lot of money available in the small business sector, and I'll take you through some of the lending opportunities. The hospitality and tourism industry has been hardest hit. As I think Michael mentioned, there was some help offered by the banks. You had to ask for it, and that was for a fixed period. Now, if you've done nothing about contacting your bank, you should be contacting your bank this month. If you're unable to revert to your normal repayments, have a think about how you can, over time, address that requirement and table that to the bank. Now, APRA is sought from the bank and got a commitment from the bank that they will be very, very sympathetic to your individual applications. So I'd encourage you, you've seen the message a couple of times already today, don't keep your head in the sand, or don't put your head in the sand. Talk to the bank. If you need help, we're more than happy to help you make a presentation for your bank. What I wanted to do was talk to you just briefly about a tranche of money that has been guaranteed by the federal government. Now, this has had a lot of press lately, and I just want to dispel some of the rumours that are going around the marketplace. So this is the government coronavirus small and medium enterprise guaranteed loan scheme phase 2. So I'll just read briefly a summary of a bulletin we've received from the Commonwealth Bank. Now, the Commonwealth Bank, along with the other major banks, administer this money. Now, it's not federal government money, it's in fact a guarantee by the federal government. The money is from the bank's own coffers. Now, it's available to small to medium businesses with up to $50 million turnover. So it includes self-employed individuals. Lending to approved customers under the scheme is capped at $1 million per your ABN. So if you've got multiple ABNs, I guess you can go for multiples of $1 million. The loan must be used for business purposes, can be used for the purchase of commercial property. The loans cannot be used to refinance existing debt other than the previous scheme loan. So you can, if you had the advantage of one of the scheme loans that ended last month, you can refinance that with a new scheme loan. You can't use it to purchase residential property or financial products such as shares and financial investments of any sort. I guess, reading between the lines, what we can say is that if you're eligible for an unsecured loan from a bank, and it's quite common these days that you can walk into a bank and get 50 grand for your business. We see that every day. If the federal government is going to guarantee 50% of your exposure, I guess if you do the maths, that means you could probably put your hand up for 100 grand. That would be par for the course. So those opportunities are available within those very strict parameters. Now the money is quite cheap for business loans. For asset financing, if you're going to use these funds to purchase plant and equipment, the rates are as low as 3.5% because that's deemed to be a secured loan. So quite attractive. If you were using it for business purposes other than to purchase assets, rates could be as low as 2.69% with a 0.7% loading for unsecured loans. So again, the money is available. It will cease to be available at the end of this year. Talk to your broker, talk to us, talk to your financial advisor, work out a plan that you can best utilise these funds, but you will be subject to normal credit criteria. You will have to prove that you can support the loan and repay it over time. But we can help you with that. So moving on from that, let's talk about the sorts of financial products that are currently available. I'm a better driver and barista than I am a commentator. Okay, right. Invoice financing. Invoice financing has been around for many years. Scottish Pacific, 20 or 30 years ago, made a name for itself as a leading financier in that marketplace. Now most of the banks and most of the second-tier financiers are doing it. Now, just so you understand, invoice financing can be a very effective tool, especially if you're a contractor. Let's just make a hypothetical example. Let's just say you're a contractor on a new hospital. Multiplex has engaged you, and knowing Multiplex, you could very well be on 45, 60-day terms. With invoice financing, you present that invoice that you can't wait 45 or 60 days because you've got to pay your staff, you've got to pay your suppliers. Present that to your financier. You take a discount on that invoice, but you get paid within 24 hours. It's a very, very effective tool for a small business. And if you think about being involved and in participating in procurement for any other organisation, I mean, we heard from Hume Housing today. Now, I don't know what their procurement strategy is going to be, and I know because of their ethics that they will pay their invoices promptly. But if they were an organisation that were managing their cash flows, they could push their contractors out for 45, 60 days. It's quite common in the commercial construction space. So invoice financing on major projects for small to medium enterprises, talk to us. We can put you into a partnership with a bank. ATO debt. ATO debt, it can be problematic. If you have existing ATO debt, it's seen as a real negative when you go to the bank to raise funds for any other purpose. So we have a raft of second-tier lenders that happily will refinance that ATO debt, take it out of the public domain, wrap it up into any other asset, and you are seeing them by the banks to be a clean skim. So ATO debt, don't let it hang around. It's quite expensive. I think 13% plus is the going rate at the moment. You can borrow money commercially at far less than that. So don't Don't leave it there. Refinancing and restructure existing facilities, that's a given. Provided that you've got a cash flow and you've got a business plan, that should be a walk in the park. Upgrade of plant and equipment. Well, the federal government is encouraging that, isn't it, with this tax relief, so with the instant write-off. So go out and buy a new tractor, front-end loader, whatever, a semi-trailer, instant write-off. Let's do it. Now's the right environment. Money has never been so cheap. Still have to be able to prove and evidence that you can repay it. We'll help you with that, but get yourself a business plan, get yourself a cash flow, and keep it up to date. Construction and development finance, always a bit difficult. Banks are more comfortable dealing with people that are experienced in that space, but you can achieve that by, say, partnering with a builder if you've got an appetite to be a developer. There are solutions to that to overcome that reluctance of credit. Fixed price contracts have to be a given, and the major trading banks are still looking for pre-sales. Generally enough pre-sales if you're building multiple residential or commercial, enough pre-sales that would satisfy the end debt. That's where they start from. We can do better than that, but you need to be talking to your broker, talk to your accountant. Asset finance, common these days. Motor vehicles, anything green or yellow, that's plant and equipment in the civil space, but anything that's got a serial number or a VIN number these days can be financed. So there's a lot of money in the marketplace, and even sales and leaseback. So if you've got existing plant and equipment, and it could be anything, it could be a lathe or it could be a tractor, it can be refinanced, put the capital back into your business, and away you go. Then we've got these specialised areas of lending and availability of money. Medico packages, it's been common, it's been around for 5 or 6 years, maybe more. All the banks these days have specialist lending areas just for people that are deemed to be in that medical space. Now, it's not just doctors, it could be physios, and it could be a lot of allied health related people engaged. So keep that in mind. There's some very generous offers because there is an assumption that people engaged in that space basically are going to earn forever and earn good money. So the banks just make an assumption, well, you're right, we'll lend you whatever you want. And some would argue that's fairly reckless, but hey, not my money. Also franchise packages. If you're interested in buying a franchise, talk to us because, again, most of the banks have a specialist franchise area where they recognise the value of national franchises, like could be a Jim's Mowing, could be a donut shop, whatever. And they value that franchise with or without your input and say it's worth, might be 4 times net earnings, and they'll lend you a percentage of that to buy into that franchise. So keep that in mind, there's opportunities out there. Self-managed super funds, just briefly, very, very hard to do. I mean, up to 2 years ago, everyone wanted a self-managed super fund. People weren't talking about footy at the barbecue, they were talking about the assets they had in their self-managed super fund. Yeah, we went through all of that, money was freely available, it's been turned off. None of the major banks will lend for new self-managed super funds. Now, APRA, which is the Prudential Authority, has come down very hard. They're concerned that people were investing in self-managed super funds and ignoring the fact that the fees over time would erode the growth or the interest, the cash flow from that was being earned by that asset. However, if you have advice, written advice, strong written advice and recommendation from your financial advisor that you should invest in a self-managed super fund and that fund has liquidity, talk to us because we do have access to a couple of the second-tier banks that are still active in that market. So it's not closed, but you're not going to get it at CBA, you're not going to get it at NAB. A couple of helpful hints. I know that some of the previous speakers have spoken about this, but it's very important, no matter what the maturity of your business is, that you have a business plan. And that business plan is kept up to date, and the underlying cash flow is kept up to date. It's your Bible. You live by that, and it's what you take to your broker or directly to your bank, and that supports the next stage of the development of your business. Without it, I'm sorry, but you seem to be an amateur. You really must have that in your briefcase and be watching it and maintaining it. Keep your BAS payments up to date. Again, the days of low doc loans have long gone. You may not have to produce an up-to-date balance sheet or P&L account. It's audited. You may not have to produce that, but at the very least, you'll need to produce your BAS statements, a copy of your rolling ATO account, and your business banking statements, and they all need to be read in conjunction and be made sense of. And that's the absolute minimum these days to approach your bank. You don't need to change banks. If you're dealing with a good broker, the first thing we would do is look at your banking relationship and make sure you're talking to the right people within that banking structure. Business banking has evolved over time, and the business bankers that we deal with on a daily basis have very, very big KPIs. They want your business, but it just has to be presented in the best way. So you don't have to change banks, you just have to be talking to the right person within your existing banking relationship. A couple of other ideas. Dealer finance. There's a lot of that about at the moment. I know up till recently you buy a new Volkswagen at 1% finance. The difficulty that you're going to have is that if you go and buy that Volkswagen at 1% finance, you will not be able to negotiate the price. Now, okay, I'm making a very, very concise and upfront statement, and I may be proven wrong, but that's the reality. That margin, that finance margin, is built into the purchase price. So don't be blind to that. It may very well be that you should be better off getting a pre-approval for whatever form of finance you want for that vehicle or that equipment, and then go to the dealer and negotiate. And it's not going to cost you anything to get that approval. And if you can still negotiate, maybe it's better off doing a deal with the dealer. Prove me wrong, but keep that in mind. It's the finance is built into the purchase price. Core overdraft debt. We see a lot of this. We had a client recently with a $50,000 overdraft. They're only using $2,000 of it. They're $48,000 sitting there earning interest, or they're paying interest on it, and it's going nowhere. In 10 years' time, they'll still have a $48,000 fully drawn overdraft and still be using $2,000. Our recommendation is take your core debt, put it onto P&I payments, and get rid of it. You don't want to leave it as your inheritance. The business doesn't deserve it, and you and your family don't deserve it. Pay it down while you can. Right? Now, you don't have to go on to a formal repayment plan with your bank if you're disciplined, but lock into a repayment plan. Get rid of it, especially in this day and age with interest rates being so cheap. A couple of things now. Personal residential lending. We do a lot of this, and it's fair to say that right now, if your home loan or your investment rate doesn't start with the number 2, you're probably paying too much. All right, so talk to us. Give Lynn a call. We'll give you a quick answer. The other thing about this industry for small to medium enterprises and business lending generally is you don't often see a business banking rate published. Now, the reason for that is business banking is set with a margin for risk. Now, you may see a base rate published, but not a lot of people earn that base rate. So when you walk in to the bank or you talk to your broker, an analysis will be made, the banker will look at the sort of industry that you're in, and there will be industry risks margins. Now, those margins could be anything from 0.25% to 1.5% over a base rate, again depending upon the industry that you're in. That's why you don't see business banking rates published normally. You'll just see a benchmark rate done. One of the things that, just before we run out of time, I thought I'd give you a bit of a case study. And this is around horses for courses. Again, making sure that you're dealing with the right bank for the business that you're in. A couple of years ago, our good client had established a Goodyear tyre service business. Not only had he established one, but very quickly established two more. So this guy, sole trader, him and his wife, very, very good business people, very hard workers. So they've got the 3 Goodyear tyre business, and one of their premises, they're renting all 3 premises, different locations of course, one of the premises came up available for sale, and it was extremely attractive location, attractive terms, and our client really did want to buy it. Came to us and said, how do we achieve this? Now, their current banking had evolved from essentially a residential mortgage with a regional state-based bank. And the bank had supported them with, all the tickety-boo stuff, FPOS machines and all that as their business grew, and a certain amount of credit. But the credit was based on the equity they had in the family home, which wasn't substantial. They still had an average-sized mortgage. We looked at and understood quickly that this bank wasn't really recognising the underlying business that was being conducted as a Goodyear tyre reseller. So we went and talked to, and I'll nominate the bank, it was ANZ in fact, went and talked to ANZ and convinced them, and it didn't take much to convince them, that apart from the value of the $1 million worth of real estate that this guy wanted to buy, the family wanted to buy, that the business itself had a value, an ongoing value, and that value would be preserved into the future. And so we ended up being able to arrange finance for 100% of the purchase price without encumbering any other assets, including the family home. Now, yeah, that seems quite easy, but what the client did have to commit to, and was quite able to commit to, was that the margin between 100% and where the bank would have normally been comfortable, which was about 70% of the value of the purchase price, that differential, that $300,000, would need to be paid down relatively quickly, basically over the first 5 years of the term of the loan. So, and that was well within this business cash flow. So here we are now, and I look back, Lynn and I look back at that transaction, we're in constant contact with the client, and he's well on his way to being a millionaire property owner with good underlying assets and a good strong cash flow. But he couldn't have achieved that with the banking relationship that he started his business with. So my message is, you need to understand the best relationship that you can nurture to nurture your business. So thank you very much. Thanks for the opportunity.
Thank you, Paul.
Sorry, any questions?
Lynn, that's my question. Any questions?
That's Lynn's LinkedIn code if anyone wants to connect on LinkedIn. You can scan it through LinkedIn.
Thanks for
So that's all right.
Get your phones out.
Yeah, get your phones out and you can connect with
Point
Lynn.
at it, it'll take you to the link on through the phone's camera.
Do you understand what this is?
Yeah. Otherwise I'll be showing that alive. Who's got a phone? Go on, who's got a phone? You got the watch. Bring up the camera for me.
It works. It works.
Awesome.
It's far away though.
There you go.
I know, it's amazing. Yeah.
And it's going straight to LinkedIn.
We'll leave that up for a little while. I have a question for you. Are the financial institutions looking closer at like debt to income ratios and LVRs?
Yeah, they are, very definitely. Yeah, very, very definitely. Even though there is a substantial amount of credit available, especially in the small to medium enterprise area, the credit criteria hasn't been eased yet. And as I said earlier, there's no such thing, for instance, as a low doc loan anymore. So you still have to be appraised as to your capacity to repay the debt over time. You still have to have equity in the deal. But as I said with the case study, that equity may not be recognised by one bank, but could be recognised by another. So we've got to get you into the right banking relationship to start with. But yeah.
Thank you, Paul.
Stick with
Thanks, Paul. Any other questions? Well, I'd like to thank Paul and Lynn.
Thank you. To the boss.